What are the top rates on the money market funds, CDs, and annuities that many of you hold in your portfolio? And how do they compare to Treasuries right now? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to a weekly update. We've gotten a lot of questions this month about how the recent and potential future Fed rate cuts might impact money market funds and CDs. And the short answer is that the rates on money market funds and short-term CDs will likely go down, just like the rates on short-term T-bills already have. As Marcus talked about in detail in this recent video about the Fed's quantitative tightening versus quantitative easing efforts, short-term rates generally follow the Fed's rate decisions closely. It's a bit different for the longer-term rates, though. The Fed doesn't control these directly. Rather, it's supply and demand in the markets that ultimately decide long-term rates. And even though short-term rates play a role, the markets think wider and about the economy as a whole when they set the long-term rates, including what the expectations are for economic growth, inflation, and possible government action. This makes long-term interest rates hard to forecast. For example, and as our Diamond NestEgg regulars already know, the Fed's last rate cuts actually pushed long-term interest rates up initially, which was not a result that everyone was expecting. Against this backdrop, though, it's important to note that both long-term and short-term rates are still at good levels relative to the historical average over the past 2 decades. So, with that in mind, here are the 3 topics that we'll be covering today. 1. What are the popular money market funds that many of you in our community hold paying right now? 2. How do current rates compare for Treasuries, agencies, and annuities? And in this section, we'll also be sharing a 4.34% APY, no penalty 6-month CD offer that crossed our desks this week. And 3. What are the predicted yields for the upcoming week's Treasury auctions? Let's dive in now, folks. What are the popular money market funds that many of you in our community hold paying right now? So let's go through the top rates on some popular money market funds within our community. And let's go in alphabetical order with the 3 leading brokerage firms that we cover the most on our channel, beginning with Fidelity, then Schwab, and last but not least, Vanguard. For Fidelity Money Market Fund comparison, we have SPACs, FZFXX, FDRXX, and FDLXX, as well as FZDXX, which has a $100,000 minimum investment requirement. And for those of you with a fair bit of dry powder parked in money market funds currently, we also have FMPXX, which has a $1 million minimum investment requirement. If you're new to our channel or to Fidelity's money market funds, please do note that the first 4 on this list are government and Treasury money market funds, and the last 2 are prime money market funds. Government and Treasury money market funds are the most comparable to T-bills in terms of risk-return profile, in that they invest mostly in Treasuries and other U.S. government debt securities, such as agencies. Prime money market funds, on the other hand, while still considered safe relative to other asset classes, tend to have a slightly higher risk-return profile than their government and Treasury counterparts. In other words, prime money market funds will generally have a bit of a higher yield relative to government and Treasury money market funds because they do not just hold government and Treasury securities in their portfolio. They may also hold highly rated securities from domestic and foreign corporations, as well as financial institutions. So, in this column, we have the name of the fund, and in this column, we have the 7-day SEC yield at the time of this taping. Remember that the 7-day SEC yield is based on the last 7 days' performance of a money market fund, hence the name. But this is then converted into an annualized rate, net of expenses, but before taxes, meaning the 7-day SEC yield should give you a good indication of how a money market fund investment has been performing for you on an annualized basis, after cost. The 7-day SEC yield for these Fidelity government and Treasury money market funds is more or less in the same range, with SPACs at 3.66%, FZFXX at 3.63%, FDRXX at 3.73%, and FDLXX at 3.63%. FDRXX does have the highest yield, though, which may be driven by the fact that its expense ratio is generally a few basis points lower than that of SPACs, FZFXX, and FDLXX. FZDXX and FMPXX have generally higher yields at 3.82% and 3.94% respectively, which is primarily driven by their even lower expense ratios and the fact that they are prime money market funds that also hold higher yielding non-government and non-treasury securities in their portfolio, as we mentioned earlier. Also keep in mind that because these money market funds do invest a part of their portfolio in U.S. government securities, some of the interest they earn on their investments may be exempt from state and local income taxes, as U.S. Treasuries generally are, which means that some of the dividends paid out to you from these funds may also be exempt from state and local income taxes when held in a taxable brokerage account, and depending on your state of residence. For example, if you had held FDLXX in your taxable brokerage account, about 97% of the total ordinary dividends may have been exempt from state and local taxes in 2024. In 2023, that percentage was a bit lower at 90%. If you want more details on this, please refer back to this money market fund video from earlier this year, link below in the first pinned comment. So, that was Fidelity. Here's our Schwab money market fund comparison. SWVXX is Schwab's prime money market fund with a 7-day SEC yield of 3.8%. Up next, we have Schwab's 3 government and treasury money market funds with SNVXX at a 7-day SEC yield of 3.7%, SNOXX at 3.68%, and SNSXX also at 3.68%. All 4 of these here are noted as investor shares. But Schwab's money market funds have 2 share classes. The investor money market fund shares that we just discussed have a $0 minimum initial investment versus the equivalent ultra money market fund shares, which have a $1 million initial investment. The ultra money market fund shares also have lower expense ratios, which typically translate into a 7-day yield that is about 15 basis points more than their investor share equivalent. So that was Schwab. Now let's move on to our Vanguard money market fund comparison of VMFXX, VMRXX, and VUSXX. All 3 of these are government and treasury money market funds, as Vanguard does not offer any prime money market funds. VMRXX and VUSXX have a minimum initial investment requirement of $3,000, while VMFXX does not, as it is Vanguard's core settlement fund. The 7-day SEC yields for all of these funds is relatively similar, at 3.91% for VMFXX, 3.92% for VMRXX, and 3.94% for VUSXX. And at the time of this taping, that's higher than the yields on all 5 of these Fidelity money market funds from before. The only exception is Fidelity's FMPXX, which has a comparable rate at 3.94%. But again, FMPXX is a prime money market fund, and there is a $1 million minimum investment requirement. The 7-day SEC yields on these 3 Vanguard money market funds are also higher than practically all of Schwab's money market funds here, with the one exception, again, being the ultra shares of SNAXX, which offers a slightly higher rate of 3.95%. But here again, SNAXX is a prime money market fund, and the ultra shares have a $1 million minimum investment requirement. And as the Vanguard fans in our community know, the main reason for these higher yields on Vanguard's money market funds is because of their generally lower expense ratios. And because I know some of you always ask, no, you cannot buy these Vanguard money market funds via Fidelity or Schwab. You can buy them via E-Trade though. So that's where rates stand for short-term cash that you want to keep liquid. with the almost 4% rates on Vanguard's money market funds still looking quite attractive if you're a retail investor like us. But here's the thing. These rates will go down when the Fed cuts rates again. You can't lock in rates with a money market fund. And at the current time, according to the CME Fed Watch tool, the market sees an almost 67% probability of another 25 basis point rate cut at the next FOMC meeting on December 10th to a Fed funds rate range of between 3.5% and 3.75%. Of course, a lot can change between now and then. Who knows, right? The Fed is currently facing the dilemma that a weakening employment picture would be calling for more rate cuts, while inflation seemingly stuck above their 2% target rate would call for the opposite, meaning stable or even higher rates. And as we often say, reasonable people can disagree on what to prioritize in such a situation. So the Fed's thinking may be even harder to predict than usual. Drop a comment below. If you were in the Fed's shoes and could only choose one option, would you prioritize keeping employment stable or inflation at bay? So, I know that some of our Diamond NestEgg regulars are taking a wait-and-see approach and continue to park their cash in money market funds, short-term bond funds, and T-bills that auto-roll, just like we mostly are. But I also know that some of you want to lock in some of the current rates for a bit longer, bringing us nicely to the next section of today's discussion. How do current rates compare for Treasuries, agencies, and annuities? As we normally do at the end of the week, let's compare the annuity, agency, and Treasury rates at the time of this taping, going from the highest rates, annuities, to the lowest rates, which is usually Treasuries. For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. AA+ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes on insurance, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to Treasuries and non-callable agencies in terms of risk-return profile. And remember that MYGAs are the annuities that are closest to Treasuries and non-callable agencies. They work essentially like a bond, except that they don't pay interest regularly, but accumulate it in the account and pay out everything together at maturity. So let's begin with some sample rates for MYGAs. Here you have the investment amount for each investment range. As requested by some in our community, we have added a new row for investments of $1 million to just under $10 million. And here's the rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this AA+ carrier, your rate might be 4.35%. A $50,000 7-year MYGA might earn you 4.45%. A $100,000 7-year MYGA might earn you 4.6%. And a $1 million MYGA might earn you even 4.65% for 7 years. And if you have more than the amounts shown here, say north of $10 million, your rate might go as high as 4.75% with this AA+ insurance carrier. So, the rates for the 2-year, 6-year, and 7-year MYGAs on this table have not changed much in the past few weeks, whereas the rates for the 3-year, 4-year, and 5-year MYGAs have moved up 5 basis points since last week. Do keep in mind that annuity rates and payouts track interest rates, and that's why they're at such attractive levels currently, because interest rates, especially at the long end, have also been tracking higher than they have on average over the past 2 decades. That said, the MYGA rates in this table are subject to change at any time without prior notice. Also remember that your personal rate may be higher or lower depending on how strongly or not so strongly the insurance company you're buying your annuity from is rated, meaning how risky or not risky your insurance company is. As I've already mentioned, your personal rate will also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's move on to non-callable agencies and treasuries, both of which are more liquid than MYGAs in the sense that you can sell them on the secondary market before maturity at whatever the then prevailing market price may be. Remember that MYGAs usually only allow you to withdraw some part of your capital per year without penalty. For example, 10%. More on this shortly. So, as this table shows, the rates on non-callable agency bonds range from as low as 3.61% for a 2-year term up to 3.97% for a 7-year term, pretty similar to where they were last week. And the rates on Treasuries range from as low as 3.55% for a 2-year term up to 3.87% for a 7-year term, a few basis points down from last week. And as we've been seeing over the past several weeks, for a 2-year term and for amounts under $100,000, the rates on MYGAs, non-callable agencies, and Treasuries are quite similar. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over non-callable agencies and Treasuries, and more substantially so the further out you go and the more you invest. So, if you're comfortable with the illiquidity of MYGAs, the lack of regular interest payments, and the possible early withdrawal penalties before the MYGA term ends or before you turn 59 and a half, and you want to lock in these MYGA rates for the long run, or if you're considering an annuity for the principal protection and guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. As we often say here at Diamond NestEgg, annuities come in many different flavors. MYGAs are more like CDs, whereas FIAs, fixed index annuities, allow for potentially higher market-based returns, tied to the S&P 500, for example, up to a cap, but also with principal protection, which may be something to consider if you want to stay in the stock market for the higher returns that equities can offer over bonds, but are concerned that we're headed towards an AI correction, or even crash, as we discussed in this latest video here on structured protection ETFs versus fixed index annuities in protecting your money against such a worst case scenario. There are also SPIAs, single premium immediate annuities, which can offer an immediate stream of lifetime income and fixed payments. And QLACs, qualified longevity annuity contracts, which are generally used to lower required minimum distributions, RMDs, defer taxes, and manage longevity risk if you have pre-tax retirement savings. You can check out these annuity videos here, all linked below this video, if you want a deeper dive into who should buy a MYGA, some other type of annuity, or no annuity at all. Or shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist to see what your options may be. Because as I often say, there's no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. And for the CD fans in our community, as promised in the beginning, we wanted to share this 6-month 4.34% APY penalty-free CD promotion with you from Climate First Bank. There is a minimum opening deposit requirement of $500 and no penalty for early withdrawals. You can open an account from this page by clicking Open Now here. I've linked this page in the description below as well. Climate First Bank was founded in 2021, is based in St. Petersburg, Florida, and is FDIC insured. Moving on now to a usual table with Treasury yields from this past Friday versus the previous week, across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. We're seeing more red and less green on our chart this week than we have in the past, which means that yields have generally come down more. At the short end, most maturities are down, with the single exception of the 3-month, which went up. We're not sure what to make of it. Maybe it was just a fluke for this week. One thing that we did find very interesting here at Diamond NestEgg is that the yields dropped most sharply for the 1-year T-bill by 7 basis points. Lower yields means higher prices, which also means that buyers must have been piling into the 1-year. How we read this is that investors still see Treasuries as safe and liquid and are buying them, but that they are also not sure what to make of our uncertain times. So they're piling into the 1 year, but also into the 2 year and the 3 year. The latter two maturities show the lowest yields of all treasuries across the range. The 2 year at 3.55 and the 3 year at 3.57. These middling maturities around the 1, 2, and 3 year mark seem to offer the right balance between certainty and flexibility for many investors at this point as they wait to see how it all develops. And at the very long end, the 20 year and the 30 year show higher yields again, as they have done over the past few weeks, which may be a sign that the market continues to expect that either the economy will pick up again in the medium term, or higher inflation, or maybe a bit of both. Or perhaps it's simply that the very long maturities may feel a bit too much of a commitment. As I often say, we don't have a crystal ball, unfortunately, and neither does the Fed. But if you can live with the uncertainty and think that long-term yields may be coming down again, then now might be a good time to buy some longer maturities to lock the rates in. Or simply to add some longer maturity treasuries, agencies, annuities, or other types of bonds to your portfolio as you continue to dollar cost average. It really all depends on your personal outlook. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. As before, this last row here shows the increase or decrease in rates since the beginning of this year. Decreases in rates are shown in red. And if we compare yields from this past week versus January 2nd, it's basically the same picture that we've been seeing for a while now. All maturities have come down from their last peaks around the beginning of the year, but are still at levels that are generally attractive if compared against the averages for the past 20 years. The only observation that we have here is that at the very long end, the gap continues to narrow. The yield for the 30 year is now only 9 basis points below the beginning of the year, and it's 18 basis points for the 20 year. You can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where rates ended the past week, let's move on to the next section of today's discussion. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bills are happening as usual. And if we scroll down, we can see that the 3-year T-note, the 10-year T-note, and the 30-year T-bond will also be auctioned off this coming week. None of these are reopening auctions, so the coupon will be determined on auction day. At the time of this taping, on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 6-week at 3.883, the 13-week at 3.792, and the 26-week at 3.721, all a bit down from last week. For the 3-year T-note, the expected coupon is 3.5, and the expected yield is 3.569. For the 10-year T-note, the expected coupon is 4, and the expected yield is 4.096. For the 30-year T-bond, the expected coupon is 4.625, and the expected yield is 4.698. Please keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So, drop a comment below and let me and the community know. What are you buying in November? Treasuries, agencies, corporates, CDs, or annuities? And which maturities? And as always, if the annuity rates in this table have piqued your interest, do check out these annuity videos here or drop us a note at jennifer@NestEgg.com so that we can connect you with our trusted annuity specialists, because annuities are not always straightforward. Everyone's financial journey is different, and your annuity should be specifically designed for you. All right, Diamond NestEgg members, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.